Well, welcome. I'm Landon Darris. I'm the Senior Director of the Global Energy Center at the Atlantic Council. And the Atlantic Council Global Energy Center, along with the COP28 Energy Transition Team, is really excited to invite you and welcome you to the Global Decarbonization Accelerator Hub and the Energy Transition Hub of the COP28 experience. I'm here today with Carlos Pascual, who's Senior Vice President for Global Energy and International Affairs at S&P Commodities Insights, Global Commodities Insights, and Paul Gruenwald, who's the Chief Economist at S&P Global Ratings. You know, the COP28, we're having a conversation around the energy transition, around achieving the climate ambition that the world has outlined, principally in the context of the Paris Agreement. We're seeing announcements happen. We're seeing action taking place here on the ground in Dubai. But this doesn't happen in isolation, right? Energy or emissions in general are a component of a very complex world. And so today we want to dive into navigating the macroeconomic and geopolitical challenges affiliated with the energy transition, because I think it's important that we not just look at this as a linear slope to net zero mid-century, but that we're also realizing there are many interplays between the geopolitics and the economic aspects of this as well. To facilitate this discussion, what we're going to do today is have Paul and Carlos both provide some context through two independent presentations, one on the macroeconomics and another on the global geopolitical outlook. And I think that's going to help us facilitate a little bit more of a dialogue, anchoring some of this thinking in the numbers and the background and details about where the global economy is headed. So with that, I want to turn over the stage to Paul. It's great to have you here. We're really excited. And dive a little bit into the macroeconomic outlook for us.
All right, thanks, Landon. Thanks very much. It's great to be here. So I'll take you through the macro. My day job and my team's day job is to provide the macro backdrop for all those credit ratings that are out in the marketplace. But we're increasingly doing a lot of thinking, kind of longer term, from a macro view, what has to happen for the energy transition. So I'll do a couple of slides on each of those, but let's just go through what's happening in the short-term macro. So this slide here basically contains our global baseline. I'm sure many of you have been watching the news, and we know that we've had a bit of inflation unexpected over the last few years. Central banks have had to raise policy rates by the steepest amount in about 40 years. We've got sort of an interest rate shock working its way through the system. But the bottom line is we think there's a good probability that we'll have a relatively soft landing. Labor markets have been pretty strong. Wage growth has been pretty strong. Demand for services has been pretty strong globally. So we think those are the ingredients to slow down next year, but to probably avoid a recession. But again, kind of depends on the labor market, but we're seeing not just in the US and Europe, but really globally, labor markets are hanging in there. As long as we have strong labor markets, we're going to have a soft landing. So very quickly, three major regions we tend to think about for global macro. US has been the star performer, growing by 5%, which is well above its speed limits. We think the Fed is probably close to done, but the US has some slowing to do. Europe's already kind of had the feed through from interest rates to macro, so growth is kind of zero-ish, a bit more in Southern Europe, a bit less in Germany. And then China's have its own struggles with overinvestment in the property sector, kind of a weak consumer rebound. I spent a lot of time in Asia. I've never seen China grow by 4 or 5%, but that's probably the new normal. So I'm going to skip a bit, and then what does all this mean for emerging markets? We're going to talk a little bit about the global south in emerging markets. So I've got sort of the positives and negatives here. Emerging markets that are more domestic-led are going to do better. Emerging markets that are less dependent on dollar funding and dollar inflows are going to be better. Emerging markets that are plugged into a faster-growing economy, Mexico's a good example with the US, are going to do better. And the ones that are going to see some challenges are the ones that are very open and trade dependent, very dependent on the US dollar and capital flows. Also, we would think the energy exporters would be doing well in this particular environment. I'm going to skip around a bit. So what can go wrong with this scenario? We actually think the risk for the next couple of quarters is that things may be too hot rather than too cold. We may have difficulty getting inflation down to where central banks want it. So we think rates are going to be around current levels through the middle of next year. Once we really start to see a clear downtrend for inflation, central banks will cut rate, but we think this higher for longer theme is going to be pretty good. Again, high dollar, strong dollar, high interest rates. If you're an emerging market that is exposed to those, you're going to see some downside. And then Carlos is going to talk a lot more about geopolitical risks. We have a war in Ukraine. We have a war between Israel and Hamas. So those are going to have potential spillovers as well. In an economic sense, they haven't been too bad yet. So let me take a couple of minutes and talk about the energy transition and the climate debate. If you talk to an economist, I don't know if you know many people like me, up until a few years ago, we really didn't think very deeply at all about what we call natural capital or the environment or the climate. We were all about growth and investment and infrastructure and plant and equipment and building human capital, and nature was kind of there in the background, but it really wasn't kind of there front and center. Maybe chapter 12 or chapter 15 of the textbook if you got around to it, but really wasn't in the middle. But now that we've got sort of natural capital or the environment and the models, we're trying to think about how does the energy transition going to work. So let me wrap up and sort of tell you two elements to this that are I think are key. One is the technology. There's obviously a very natural tension between making the economic pie bigger and emissions and contribution to global warming. So technology is going to be key. Just to give you an example, think about the Inflation Reduction Act in the US. That's not named properly, but it's really trying to accelerate the energy transition in the US. They are trying to incentivize carbon capture, long-term battery storage, and green hydrogen. So those are the sorts of things that can improve the trade-off between growth and the environment. So if we're going to have a successful transition and continue to be able to have healthy economies, the technology is important. That's number one. And then number two is the financing, and I think that's going to get a lot of attention here. I think the screen just got stuck there. Even if we've got the technology, we have to get that to the global south and the countries that are going to need some help with the financing of the transition. We know about the divide between concern about the environment in the global north and the global south. I spent many years working for the IMF, so I'm pretty familiar with adjustment programs. But the south is going to need financial help to adopt the technologies that will help us in the energy transition. There's a lot of money out there. There's a lot of dry powder out there, but getting that to the countries and the companies that need it is going to be a challenge. There's a role there for the international institutions. There's talk about reconfiguring the World Bank to focus more on the climate transition. We know that we're going to need private capital. There's a lot of private capital, not just the formal bit, but some of the private market and private equity stuff as well. So all of that's got to come together. So we've got technology, we've got financing, and then one final note, we need to pay attention to the distribution of income and the distribution of gains. I am not a fan of the win-win transition. I mean, anytime you have a transition, it makes the world better, but there are people and industries that win and people and industries who lose. We've got to make sure we take care of everybody and maintain political support. This did not happen with globalization. I don't know if you guys know about the elephant chart. I didn't put it up here, but not everybody was a winner in that transition. We got to make sure that we try to spread the benefit and the gains for the energy transition as much as possible. So that's my 10 minutes, Landon. Back to you.
No, Paul, I appreciate it. And before I move to Carlos, just a couple of thoughts on the presentation here. First, if I was to add a third marker, and I think you actually alluded to it effectively, which is the human element, which comes in two phases. One is the reaction on a very individual level that people have to energy transition, to the economic outlook. And two is the human capital that needs to be in place to enable the energy transition to begin with. We're talking about an extensive expansion of the existing energy build out in the energy system of the world. 4x what we have today, I think it's 80 million kilometers of transition that needs to be built to meet the net zero outlooks that the IEA's put out there. Can you speak to the human element?
Yeah, well, first of all, labor markets and transition are going to be key, right? We've got new technologies. We're exiting old technologies. Labor markets are not static thing. We should be able to retrain people. I'm a big fan of lifelong learning. I just explained to you how I'm learning about climate after being a professional economist for 25 years, but there's a role for policy there and a role for market. And something you touched on, Landon, very quickly, I want to talk about it, is permitting. You know, if we're going to make the transition from, you know, a hydro world to a renewable world, permitting's got to happen for transmission lines and all sorts of other stuff. So people need the training and the mobility and the, I would say, the support, the social network to be able to change jobs and relearn and move a lot of people in the transition. If you look back 50 years, a lot of the companies that we know today, the Googles, the Metas, the everything else, they didn't exist, right? So there's going to be new companies, new technologies. Labor's got to change to meet the challenge.
Well, so I'm really interested in this shift in the economic outlook and how you're thinking about the problem set. Because, you know, people, if you're not building the scenarios to net zero 2050, a lot of people don't have an appreciation of all the intricacies of how the assumptions that are driving those outcomes and where we're headed. And a big one is, of course, the geopolitical outlook, what the world is facing in a very complex situation right now. So why don't we turn to Carlos for your presentation, Carlos, and provide a little bit more context, and we can jump into this together.
Landon, thanks very much. Thank you for the Atlantic Council and all of you for joining, and everybody who's streaming this online. It's great to be talking to you around the world. Paul, tremendous foundation on the economic side, and I'll go into the political component. What I'm going to talk about is perhaps one of the most difficult challenges that we have had in history. And it's not just an issue of economics or politics or energy, but it's a change in the very foundations of the global order that have driven prosperity for the past decades. One of the things that struck the world when the war in Ukraine began, we see it repeated again in the situation in Israel and Gaza, is that the security system that we've built, the United Nations and other institutions, have not had the capacity to prevent these wars, and we don't have the capacity to stop them. If we look at the international trading system, the pandemic gave us a shock, not just the shock that we all felt around the world, but the global trading system began to fail, and we had disruptions in supply chains that we had never expected. And with the war in Ukraine, what we also began to see were commodity shocks that gave us a new reality of whether we had the capacity to ensure energy security at the same point in time that we were trying to achieve an energy transition. And so what we're trying to do right now is not just to address the energy transition issue. We have a whole challenge of a deteriorating global order that hasn't been replaced. And if you ask us, is this getting any easier? The answer is no. And all of these conflicts that you see here behind me are making it even more of a challenge. Up until October 7th, one of the principal issues that was concerning the world of geopolitics is the relationship between China and the United States, the deteriorating relationship. And it was such that it brought the President of the United States and President of China together because, in fact, they were worried as well. And can that actually sustain or put a floor under that deterioration that we've seen? With the war between Gaza, between Hamas and Israel, the biggest question that still remains out there is how do you bring it to an end? Now that Israel has gone into Gaza, eventually what does it turn into? How do you create stability there? And what are the implications for the wider region? If you look at the situation between Russia and Ukraine, it's hard to see where the diplomatic solution lies. And now, at the start of winter, what we're likely to see is increased aerial bombings on the part of Russia on civilian infrastructure in Ukraine to try to get a Ukrainian submission, which I don't think will happen, but we're likely to see even more humanitarian tragedy there. You see it in this conference here on the issues in the North-South divide, the kinds of questions that Paul raised about access to finance and energy. But in reality, this question on the part of the Global South of saying that they need a new reconceptualization of international debt, of access to finance to be able to grow. And then finally, one of the things that I'm a former American diplomat, and this is a challenge for me to say, but potentially the biggest risk, geopolitical risk confronting the world over the next year is what happens in the American elections and the polarization that has occurred in the United States and the extent to which that makes it difficult for the United States to be a unifying force for change. So if we take all of those things and you ask the question, in the next year, is this going to get any easier? The answer is no. It's not going to get easier. It's going to get more complicated. It's going to get messier. So if you ask the question first of what does that mean for energy markets in the near term, all right? So I'm going to talk about a couple of things related to oil prices, which you're not going to hear too much about in this conference of the parties, but it's something that we have to keep in the back of our minds, because what happens when oil prices rise, right? Politicians get worried. They get upset. They take measures. If there are elections that are coming on, and in 2024, there are more elections that are going to happen across the world than we've ever seen in history, right? So the impact of prices is going to have a big effect. Now, one of the questions that, as I've traveled around the world, so many companies and countries ask me, after October 7th and the terrorist attacks in Israel and the Israeli response in Gaza, why is the price of oil going down? And geopolitics is at the center of this. And one of the things that you have to realize is, why does the price of oil usually go up when there's a crisis in the Middle East? It's if there's a threat, usually been on the part of Iran, on the Strait of Hormuz, on the transit of ships, and what we've seen is that hasn't happened. What you see in those green lines is recent movement on the part of ships in the Gulf and the Strait of Hormuz. And why? Well, where is most of that oil going to? It's going to China. Iran's biggest client is China. They cannot hurt the Chinese interests. What is China's biggest interest in the Middle East? It's in Saudi Arabia. That's where they're principally invested. And ironically, it's that relationship between China, Iran, Saudi Arabia that has been a stabilizing factor from an energy standpoint and an energy price standpoint in the Middle East. The other factor has been the basics of supply and demand. Oops. And what you see in these blocks here, on the left-hand side of these blocks, is growth of oil supply in non-OPEC countries, all right, outside of OPEC or OPEC plus. And what it's telling you is that the growth of supply is actually going to exceed the demand in the coming 2 years. And as a result of that, that is a counterbalancing factor in prices. And it also has an interesting opposite effect. It means that Russia and Saudi Arabia, if supply is going to be high, relatively high toward demand, the implication is that's going to have a downward pressure on price. What does that tell you about the incentives within OPEC? They're going to want to control the amount of supply that goes into markets in order to be able to push that price up. And it starts to give you some insights of where prices are going to be. And the middle of a huge amount of volatility, what we're projecting is that we're going to get relatively stable prices, a lot of ups and downs in the middle, prices between $75 to $90 a barrel. But what's that telling you? And this isn't a very popular message at a conference on climate change, but there's still going to be significant demand for oil. There are still going to be relatively high prices. So if we put that in the context of energy transition, let's come to this. These are scenarios that we've developed at S&P Global on what the future might look like in terms of the reduction of emissions. There are two lines that you see that go to zero at 2050. They're net zero scenarios. To be able to get to those net zero scenarios, we had to start at zero and go backwards, right? We mathematically had to calculate them because we couldn't get there otherwise. And if you look at the International Energy Agency Road Zero roadmap, what they'll also tell you in a paragraph that is there in the report is that commercially viable technologies do not exist for 50% of the emissions that have to be reduced. What does that implicate? This is hard. The business as usual case, the case that we're on right now, is the blue line. And that corresponds pretty much with the studies or the analyses that the Intergovernmental Panel on Climate Change is using. And if you look at the green diamond, that is the objective that has been declared at this COP for 2030. And the interesting thing is that that green diamond is below even the most ambitious scenarios that we have today. So in other words, we're setting goals for the future that we don't know yet how to achieve. It means that there's going to have to be massive technological innovation. That's going to have cost implications. It's going to have economic implications. It's going to have social implications. If we look at what that means in the relationship between fossil fuels and energy demand, this chart begins to tell you something. That black squiggle that you see represents that 80% of energy demand between 1990 and 2022, 80% of it was supplied by fossil fuels. It reduced by 2% during that period. And people ask, what happened to the $6 trillion that were invested in renewable energy? That funded renewable energy that addressed demand growth. Now, what are we saying that we need to achieve between now and 2050? Those two lines that cross the zero line imply that if you use carbon capture and you have carbon trade, that will have somewhere between 20 to 30% use of fossil fuels. But they're telling us this, that over the next 27 years, after we've reduced only 2% in the last 32 years, in the next 27 years, we're going to have to reduce the use of fossil fuels by 50 to 60%. And that's going to have an impact on every single one of us, right? We have to make different choices of what we do every day when we get up in the morning. Whether you turn the lights out in the room, what kind of transport that you use. If you don't change that, you don't change demand. It's going to have implications for the economy, for technology, for geopolitics, of who are going to be the winners in these situations. And it begins to underscore how huge this challenge is. One of the things that we do know is that electrification is going to be central to the equation. No matter what scenario you look at, you see massive increases of electrification. But here's another geopolitical issue that we have to deal with. In this chart, what it demonstrates in blocks between 2020 to 2025, what countries control the supply chains for minerals and metals that are critical to electrification. So if you look at lithium hydroxide and who owns it, that bright green means that it's owned by China. If you look at battery cells and batteries, the bright green shows that they own cells, batteries, and recycling. If you look at the middle line, which is cobalt, it tells you that 80% of it is in the Democratic Republic of Congo. If you think about copper, copper is the key metal that is necessary in electrification. It has to double by the year 2035, but it takes 16 years to start a copper mine, right? So it begins to underscore a different challenge that we're going to face in technology, but in geopolitics as well. So two last slides I just want to show you. The reason I put this up is if we think about the world and where this is a problem, look at what's increasing on the top in demand and on the bottom in emissions. And it's in non-OECD Asia. What it's telling us is that if we can't solve the problem in Asia, we can't fix the climate problem throughout the world. So what is going to be necessary to be competitive in Asia? And if we were in a conference in an Asian room, they would be telling, if you deny access to natural gas, to switch out of coal to natural gas, you can't make this progress. And that, again, is another huge issue that is being debated in this COP as well. So I'll leave you with this observation. What the first part of the discussion told us is that there is a real demand there for hydrocarbons. And if you don't satisfy that demand, and demand is the hardest thing to change, right? If you don't satisfy that demand, prices increase, politics get more complicated. So we need to find ways to bend that demand, decarbonize that supply. And yet at the same time, what we need to figure out how to do is how to create the energy economy of the future. And we know what some of the technologies are, like solar and wind, geothermal. But then, Paul mentioned it earlier, hydrogen, carbon capture, fusion. Are they going to come into the equation as well? And the challenge is that we have to do both of these at the same time. Because you can't say, well, I'm going to finish the first one and then I'm going to go to the second one. That doesn't work. The problem gets worse. And that's the challenge that we have. How do we finance this? How do we develop the technologies? How do we do that in a way that brings in the developing world, as Paul said? Because if we don't do that, we don't have a just transition. And these are some of the hard truths that we have to face. And I try to lay this out there, not because I'm saying we can't succeed, but because if we don't confront these hard truths, if we don't figure out how to address some of these questions, then we won't succeed. We have to confront these realities and understand how to be able to move forward. Landon, back to you.
Thanks, Carlos. It's a very compelling story, and I think there's a lot to build on here in a very limited amount of time. I want to tie the two conversations together. You know, here at COP, and frankly, the COP itself, there is a announcement yesterday, and it's been in the news for quite some time, that the ambition of 3 times renewable energy deployment in the global economy. There was also 3x on nuclear yesterday. So we're trying to amplify these countervailing technologies and, you know, clean zero emission energy resources. Paul, you outlined, you know, the near-term economic outlook. How is the current price environment, the ability to access capital, what the Fed is doing, the interest rates, going to impact that deployment? I know that renewable energies, a lot of these technologies, both nuclear and renewable, very capital intensive at the front end for the returns that they're going to experience.
Yeah, well, there's two phases to that. One is the development, and you know, if you think about where a lot of this innovations taking place in this experimentation, Carlos is absolutely right. A lot of the technologies we need for the renewable transition aren't in place yet. You can almost think about you know, places like Houston, Texas, which, you know, is known for its oil and gas, but now it's built around energy transition. There's a huge amount of technology going in there, almost going to be like a Silicon Valley for the energy transition. So, as I said earlier, there's a lot of dry capital or dry powder that's willing to go in and finance that, and it's risk capital. I think the challenge is going to be, well, there's the technological challenge of making that, you know, sort of making that sort of fundamental research into reality. But then the other challenge is going to get the money into the global south in order to do the transition. And again, Asia is the key. If you look at India, China, I would put Indonesia probably in there as well. Those are the countries that are going to have to, you know, massively decarbonize, because the trend is already downward in the OECD. Getting money into there is going to need multilateral organizations. You know, these are global public goods now. Everybody has to succeed. We can't leave a couple of big countries out. But I think the catalytic nature of the IMF, the World Bank, some of the multilaterals, even some of the big bilaterals, is going to unlock some of the other money. But there's two bits to that, so I think both are important.
Carlos, let's keep thinking about the Global South. In her essay for the Global Energy Agenda, that the Atlantic Councils were putting out essays from leaders throughout this COP. Dami Lola for SE for All said that, you know, up to 80% of the global population lives in net energy import countries. And, you know, an anchor of energy security for a very long time has been about diversification. The new energy landscape, so you're talking about doing both at the same time. One is diversifying sources, resources, opportunities in a conventional sense, but also enabling the side you had on where the critical minerals and metals are coming from. How do we need to be thinking about diversification in the context of the energy transition for these countries to be empowered?
Landon, I think that's one of the biggest issues that's confronting the world, and the fact that we don't have great answers about it is reflective of the scale of the challenge. I was on the Executive Committee on Sustainable Energy for All in around 2012, 2013, and many of the same questions that we debated back then are exactly the same questions that are being debated right now. how do you do this in a way which is replicable, which is at scale? And we've heard a lot about the importance of distributed energy, distributed solar in particular. It has a huge impact, but how do you multiply it in ways that has an impact that is significant globally? India has had tremendous experience in this. They've had to have financing institutions at a local level that are able to do it, but it's been slow in order to be able to achieve it. And so one of the questions that is being asked is, how do you change the mechanisms of financing and procurement in order to be able to give developing countries greater access? And I'll give you an example from the oil and gas sector and then ask the question, how does it translate to renewable energy? When an oil and gas company invests in Africa, for example, they're generally not going to the market to finance that, or if they are, they're doing it using their balance sheet. It's not the country that's using its balance sheet, right? So what's the political risk of that capital? The political risk of that capital is very low. And as a result of that, they're paying interest rates that are the same as that they would be paying in pretty much any other parts of the world. What happens if a developing country says that, I want to build 200 megawatts worth of power in Lagos, right? Now you're in a different situation. What's the political risk of investing in Nigeria, in Lagos? What's the capacity of that utility to be able to collect revenue and to repay that debt? But what if you change that? What if a country goes out and says that we want to build 200 megawatts worth of power, and we're going to ask companies around the world to bid on it? So you have the Iberdrolas and the Enels and others, the Mastars, bidding on it, and they're using their own balance sheets, not the country's balance sheets, to be able to raise the capital. There's still the risk of being in that country, but what a difference might it make if you suddenly change the equation of who's borrowing and what the cost of capital is? And it's sometimes simple things like that of how you would change the administrative approach to getting capital into the marketplace and into developing countries that is going to be potentially, I think, a game changer. We have to be thinking about not just the innovations in technology, but in the administrative mechanisms that are put in place in order to move capital to where it needs to be.
Paul, there are a lot of conversation around the developing world in the context of this COP. I think that voice of the global South per se, really picked up steam during COP27 in Sharm el-Sheikh, Egypt. But ultimately, the bulk of emissions are coming from two countries. They come from the United States. They come from China. And of course, if you look at the European Union at a macro scale, also the European Union, you talk about each of these economies independently. But the supply chains and the future of the energy transition are much more intricate. Is there a pathway for the rest of the world, for Asia, to have an economic outlook that is successful absent China?
No. The short answer is no. I don't think there's a path for anybody. If you decompose global growth over the last 3 decades, global growth averages about 3.5%. 1/3 of that has come from one country alone, which is China. So China has contributed about 1.25 percentage points to global growth over the last 3 decades. As I mentioned earlier, China is not a 7 or 8% growth story anymore. It's maturing. It's got some, relatively rich country problems now, so it's a 4-ish. Maybe India can take the baton, but it's just inconceivable that we have strong global growth without a strong China. And even the supply chains you mentioned, we have all these new terms, right? Near-shoring, friend-shoring, whatever shoring. If you kind of disassemble all that and look where the ultimate trade comes from, it's still coming from China, right? The U.S. may import more from Vietnam or may import a bit more from Mexico, but once you go past the supply chain and go all the way to the back, it's still a China story. So we can't do it without China. We can't do it without the U.S.
And Carlos, you mentioned that President Biden and Xi got together, obviously, at APEC in San Francisco. What does that outlook? How do we engage? How does the United States, how does Washington engage successfully with Beijing to be an amplifier of the energy transition as opposed to a headwind of what it seems, as Paul's pointing out, to be relatively inevitable for us to have to engage in for the energy transition's success?
It's going to be an evolutionary process, Landon. Yesterday, I don't know how many of you might have had an opportunity to see it. There was an extraordinary event yesterday afternoon. And Xie Jinhua, the climate negotiator for China, John Kerry, the special presidential envoy on environment for the United States, were together with Sultan Al-Jaber and the president of Nigeria. But the central part of the attention here was on China and the United States. And what did the two of them say? That there's a commitment on the part of both countries to report emissions, but in particular, non-CO2 emissions in a way which is disaggregated. Why is that important? The focus here was on methane. And methane is hugely important because its impact over a 20-year lifespan is 80 times greater than carbon dioxide, right? So you can't fix the climate problem without fixing methane. And what the two of them were doing is saying that we are going to work together, report and make sure that we have transparency and visibility on methane emissions, and that will give greater capacity to take action and make investment. It's not only huge in a climate agenda, it was huge in a political agenda because what they were both were saying is that despite the tensions between our countries, we need to find a way to cooperate. Because if we don't cooperate, we can't find a way to create some stability in the world, not just on climate, but on economic growth and political security as well. It isn't going to be easy. The other issues have not gone away. For China, a huge issue continues to be the economic cooperation, but in particular, access to semiconductors. Why? For China, the access to semiconductors is its future of supercomputing and artificial intelligence. With the United States and China, from a security perspective, the issues of Taiwan and the South China Sea are still there, are still extraordinarily complicated, and Taiwan is going to have an election in January, which is going to complicate it even further. And so we have to see how it evolves. It could change. But the fact that they came together and the two of them were essentially giving a similar message, this is so significant for the world, but actually for the two of us, that we have to do something to try to mitigate that political risk and to put a floor under it. We're going to have to keep watching how it goes. If you're looking for signposts, look at what happens in January in the Taiwan elections. Depending on who wins and what their politics are, that's going to have an impact on the rest of the world. If you're looking for another signpost, look at the American elections, because China has become an issue that has brought together the Democratic Party and the Republican Party in a way which is very aggressive, and we'll see how that plays out and evolves.
Well, the methane announcement yesterday, was one of many announcements affiliated with the Global Decarbonization Accelerator and the topics that we're bringing together here in this pavilion in the Energy Transition Hub. In addition to the methane announcements that we saw yesterday, you had an oil and gas decarbonization charter signed. It was 50 companies, 29 national oil companies, to reach net zero emissions, scope 1, 2 by mid-century, but more importantly, I think, was the 2030 methane benchmarks in terms of near zero methane. Paul, what does it mean? This is the first time we're engaging economies and national oil companies that have a very different disposition to the energy transition than an international oil company that has to respond to shareholder interests and has different separate pressures. Even these national oil companies are charged quite often with underwriting the economies of countries. And one of the big instigators of the oil and gas decarbonization charter, along with the COP presidency, was Saudi Arabia. So when we're thinking about some of these economies and they're making decisions like this, how can they successfully navigate to maintain stability for their economies as they undergo this transition? These are major energy providers, conventional energy providers.
Yeah, absolutely. Well, let's do methane first because that was easy. Carlos mentioned this already. That has always been on the list of low-hanging fruit, right? So the fact that we could get some agreement with the U.S. and China there, I think, was very significant. On your other question, let's go back to this idea of this dual transition. We've talked about this all session, where we're decarbonizing the fossil fuel system and we're building out the renewable system. If you've put all your eggs in the fossil fuel basket and you've got a long-term horizon and some of these sovereign wealth funds do have long-term horizons. They don't have shareholders and quarterly reports, et cetera. They've got an interest in looking out not just years but decades. It is very much in their strategic interest to make sure that they're involved in both of those paths, the decarbonization of the fossil fuel industry and building out renewables. And if you define that probably broadly, you get into capture and some of the other things. We no longer have oil companies, we have energy companies. So I think it makes a lot of sense strategically to kind of move in that direction and not just put all your eggs in one of the baskets. We're going to have, as we've been discussing, this dual system for a while, right? We're going to have fossil fuel, we're going to have renewables. The balance is going to be changing over time, and I'm sure anyone with a long-term interest, whether you're an energy company, a government, or someone else, is going to sort of think logically about that and strategically, and I think what's happening makes total sense. But you're right, a couple of years ago that wasn't even on the radar screen, and that's progress in a way that's now a mainstream part of the discussion.
So, I think that that's the whole heart of the conversation here, which is we can't take any of these issues in isolation. And so as we're talking through the consequences, which may be unintended at times, of economic and geopolitical decisions on the energy transition, I want to come back to the fact the West is making policies. And by the West, I'm thinking about Brussels and Washington, D.C., principally. The transatlantic community have policies on climate that have significant, maybe even unintended consequences on the developing world. And that became acutely in focus, I think, after Russia's invasion of Ukraine. And Carlos, in that moment, following policies for decades, or well, maybe a decade or 5 or so years of having multilateral development banks, EBRD, pull back investment into fossil energy, into conventional energy. The Europeans, in principle, went to Africa and other developing world and said, we need your fossil resources, we need your energy resources. And in my opinion, that really galvanized a lot of what we saw at COP27 in Sharm el-Sheikh and why we have this growing policy on the global south. Can you speak to how we can navigate, how Brussels, how Washington can think through climate policy constructively, that it is approachable to the global south, and that we can make, this doesn't become a wedge issue or it becomes further concentrated and polarizing?
My first comment is we should set up another session exactly on that topic, because we could spend hours talking about it, because it is a huge challenge. One of the fundamental questions that we have to recognize is that there's a lot of anger and a sense of being ignored on the part of Global South for a long period of time. If we look at what happened with the war in Ukraine, it caused huge commodity shocks that increased the prices of commodities. It eventually led into the period of inflationary, not just because of that, but other factors, the inflationary period we were in, but higher interest rates. Those higher interest rates for countries that had dollar-denominated debt, when they translated that into their own currencies, it means that they were using more and more of their budget just simply to pay their debt. And they didn't have funds to invest in healthcare, education, or in infrastructure. And then the climate debate was increasingly saying that you shouldn't develop your hydrocarbon resources because that's against our climate change ambitions. And then the very act that you mentioned, Landon, of European countries going to Africa seeking gas supplies, there was an irony to this, because they were saying we want short-term contracts because we don't want you to develop your LNG in the short term because gas is going to be counterproductive to our global ambitions. But in the meantime, I need it now, which led to developing countries saying, but hey, we have a transition to go through too, and what should we be able to do? And so it raises a very fundamental point of how do we think about hydrocarbons in the course of this transition? Who has a right to develop them? What's the relationship between developing countries and international companies? And what we're hearing increasingly from the Global South is, what would be constructive here is if those companies in the North, the international companies, are sharing their technologies on helping us to decarbonize so that we can actually compete in the marketplace and be able to use those resources and compete, so it's not just something of international companies being able to do this. The second thing that increasingly has arisen is the question of then how do you get additional financing for renewable energy resources going into the South? We talked about that a bit before. But let me give you an example of one renewable energy company that they gave me. Right? They said that when they go into Africa, their principal clients are oil and gas companies that want to use renewable energy to power their platforms. And that maybe then they can use that to provide power into neighboring communities. And the reason they said that is because they'll pay me, right? And if I go into a utility in a dense urban area that is collecting 70% of revenue, I'll never get paid. Right? So a different question has to come up here of how do we change these factors of risk? And this is what we haven't completely solved. I talked about changes in the way that procurements are done, but there are bigger issues of how do you use international capital from the IMF, the World Bank, other institutions. And Paul, I don't know if you want to comment on this and what happened at the Bank Fund meetings in Marrakesh and how much may not have happened as well. But what countries are asking is, how do you use international resources, not just to lend me, but to make available, to put guarantees on private capital so we have those capital resources released? Because here's the other problem. If we don't have private investment, we fail. Right? We just fail. Because right now we are $4 trillion short on investment in energy transition every year, and there's no way that you're going to get that out of public resources. So we have to find a way of being able to leverage private capital to the developing world. How do you use public resources to be able to leverage that and to mitigate some of the risk?
Yeah, very quickly, let me jump in. That issue did come up at Marrakesh at the IMF World Bank meetings in early October, 2 months ago. The big issue was I guess the realignment of the objectives of the World Bank. As many of you know, the World Bank's main task is poverty reduction and alleviation. There's been some discussion with the new president, Ajay Banga, whether the bank can reposition that message to have both poverty alleviation and climate change. I don't know what's happened in the last 2 months. I think there's a big discussion there. There's a big institution. It's going to be like turning around the ocean liner. But I think Carlos is absolutely right. You know, there's the $4 trillion per year that we need in investment. And by the way, we didn't mention this yet, but building out these two energy systems, decarbonizing the old one and building out the new one, there's a lot of investment and employment and opportunities there, but it's not going to happen in the South without some private capital. Again, they're not going to fund the whole thing, but they like to use this word, and when I was at the fund, we like to use this word of catalytic. It's money that takes out certain risks and unlocks private sector money. And again, going back to my earlier comment, there's not a shortage of global capital. There's a lot of dry powder who wants to get in there, but if certain risks aren't neutralized by a public sector balance sheet, I don't think it's going to happen. So that's the critical role of the World Bank and other multilateral institutions in this process.
Well, gentlemen, I unfortunately have run out of time. Carlos, I will take you up on a future panel opportunity to dig into these issues at a later date. I appreciate that you share a passion for thinking through the economic challenges, the geopolitics, so that we can enable the energy transition. I forgot in the beginning to remind the audience and those watching that these panel discussions are being live streamed and will be published on the Atlantic Council webpage. Please visit us for details about GDA Connect and the agenda. The next event will be about public-private partnerships to shepherd investments in critical minerals. So we're thinking about the critical minerals track. Carlos, Paul, thank you very much and enjoy the rest of your day here in Dubai.
Thank you very much, Landon.